Thanks for joining me. My name is Joshua Gottfried. I'm co-founder and partner at Gottfried and Somberg Wealth Management. Education is part of helping people achieve their financial goals. And in the next 4 minutes, I'll explain how interest rates react to the economic news of the past month, as well as what they can tell us about future economic policies. So let's start by looking at a graph of the yield curve. And what this graph shows us is it shows us what the yield curve looked like a month ago in blue and what it looked like just last week in red. And you can see that there's a change that we saw, especially as we go further into the yield curve. So let's just walk through this. The y-axis shows interest rates from 3.7% to 5.7%. The x-axis shows the time to maturity from 1 month all the way out to 30 years. Now let's start with the similarities. The similarities are pretty straightforward. It's really the first 2 months. So let's just draw a line here. And what this basically shows is over the next 2 months, there's really not any expected change. But then starting in month 3, which is September, there's an expected change where they're looking at interest rates that are not going to be the same. In order to show what expected interest rates are going to do, I'm going to use what they call a forward rate. And what that is, it's the difference in the interest rate month to month. So if you have a bond that starts at 4.9% and goes up to 5.5%, what you're going to see is you're going to see that the forward rate is roughly equivalent. But when this goes from 5.5 down to 5.38, you're going to see that the interest rate has to fall. And it just doesn't fall the difference between 5.5 and 5.38. It actually has to fall all the way down to 5.1. So that way, on average, the 3 months are 5.38. If we continue this and we go a little bit further on this, what we see is we see that the forward rate, if we go to a 6-month bond, this 5.18 number goes down to about 4.8%. We take a look at the 6-month bond here on the top line here, the blue line. What we notice is this number is basically the same. This number is basically the same. So let's not worry about those. But this number here, when it drops to 5.3, that's going to drop to about 5.12%. So that's going to fall. If we continue down this blue line from here, it goes from 5.12 down to this is 4.8. This is about 4.3%. The forward rate here is around 4.1%. This goes down to about 4.0 and it basically stays there here. This being basically what the terminal rate is of the interest rate declines that are expected. We fill in the rest of the yield curve from last week. Goes from 4.8 down to 4.4. Continues falling down to about 3.9, 3.8, again around 3.8. So what we see here is we see this terminal rate here is lower than what was expected a month ago. And we also see that it's happening faster as well. Now, if we add all these together, what we're basically looking at is we're looking at, in a couple months now, there's an expectation of interest rates to fall by, call it about 25 basis points. We're expecting another 25 basis points to drop here, about another 25 to 50 basis points here, about another 25 to 50 basis points here, and it basically stays flat there. So when you add these all together, what you get is we're going to go from about 5.5 down to 3.8. So it's about an expectation of about 1.75% drop in total interest rates. If we add all the ones above, what you see is really the first one doesn't start until later on, right? It's not going to be until 6 months from now, and that's about a 25 basis point drop. Another one 6 months later, another 0.5% a year later, and about another 25 basis points from there. So if we think about it right now, the expectation is that interest rates are going to fall by about 1.75%. Here, as you can see, if you add all these things up, it was a lot less. It was about between 1.25 and 1.5%. So what's interesting about this before we go any further is that if we think back to the last 35 years and we look at what happened during recessions, the Fed historically cut rates by an average of 3.9%. So neither of these models are showing us that there's going to be some sort of a recession. It's just that there's going to be some sort of a fall, and that the interest rates now are expected to fall faster and further than they were a month ago. And this change really continues the bias that we've seen in the bond market, where interest rates have been expected to fall since all the way back in March 2023. And through the past 12 months, the Fed has resisted lowering rates and has communicated they're waiting to see inflation fall further and for the economy to weaken before making some sort of a change. But last month, we saw data points that meet both of those criteria. Inflation cooled down to 3% for the first time. The jobs report was weaker than it had been in the previous months, though in line with what was expected. The unemployment rate ticked up to over 4.1%, which is a 0.5% higher than it was this year. Over the next week, the Fed's comments from their July meeting, will come out. The next Fed meeting will be on September 17th and 18th. Between now and then, the bond market expects at the end of that meeting for interest rates to be cut by 0.25% roughly. We expect to see that on the meeting based on what the markets are telling us right now. And we'll go through the yield curve again after that to see if the market got it right, or if, again, the Fed's pushed off cutting interest rates that much longer.